Thank you all for joining us today. My name is Stephanie Lucas. I'm the founder and CEO of the Annuity Consultants. We're very excited to have you here. We have some really good content to share with you today. And we're really excited to have Crystal Clark in studio with us from San Diego. She is the VP of National Accounts for DI and Long-Term Care here at the Annuity Consultants. So I'm going to turn it over to Crystal to introduce herself and just, tell us a little bit.
Thank you. I'm Crystal, for those of you who don't know, and like Stephanie mentioned, I do disability and long-term care. And for myself personally, I have a story of disability with regards to my mother. She was diagnosed with a brain tumor years ago and had to have surgery to have that removed, and has since been on disability. But in my family's case, they unfortunately did not have disability coverage. So, she relies on a small amount of money from the government for her disability, and that's definitely changed the way, they have to operate in life. And I feel like it's just even more reason to advocate for disability insurance for people to think about what might happen if they don't have that income coming in every month. I have Robert Clark here with us as well, and he's going to give you a little more information about why disability is so important to him, and walk us through some things to think about with regards to that kind of coverage for your clients.
Perfect. So yeah, we're super excited to have Robert here with us today. He'll be presenting on disability income planning and protection. So we have a lot of good stuff coming up here. But before we get started, a couple of housekeeping tips. If you would, throughout the broadcast, put questions in the box over to the right on the control panel where it says questions. We would love to answer those as we're going through. So we want you guys to be engaged in the presentation. Anything that you have, certainly feel free to ask, and we will pause and answer your questions as we're going through the presentation. You can submit it as, private if you would like to. If you don't want people to know who it is that is submitting it, that's okay too. But we will definitely get to all of the questions. We'll run probably around like 40-45 minutes. And if for some reason we don't get to all the questions, we will certainly send those out in an email. At the end, we're going to have the recording available. We'll get that email with the recording, any unanswered questions, and then also at the end, Robert is going to share a free gift that he has for you. So we'll make sure that all of you get those in an email in the next couple of days, and then feel free to share them with your friends and colleagues. We really appreciate that. So without further ado, I will introduce Robert. We're so thrilled to introduce our speaker today. He's an income protection specialist who found his calling in the industry that saved his family after the loss of his father in 2011. It was the disability insurance benefit they relied on for 20 years prior that made all the difference. Robert carries out his passion to help advisors build sound income protection practices using a consultative, goal-driven process. As a former board member for the National Association of Insurance and Financial Advisors and the ALS Golden West Chapter, Robert continues to serve his community through volunteering, coaching, and financial education workshops. A past recipient of his local 40 Under 40 and Ultimate Male Rising Star Awards, Robert holds multiple industry designations, including Group Benefit Disability Specialist, the GBDS, Disability Income Fellow, DIF, and NAIFA's Life and Annuity Certificate Professional, LACP, and Long-Term Care Professional, LTCP. Welcome, Robert. Thank you so much for joining us.
Thank you so much, Stephanie. Thank you, Crystal. I'm very excited to be here. And Stephanie, as you mentioned, we do have a worksheet that we're giving away following the close of this webinar. So make sure that you stay here through the end. I know it's a 40-45 minute probably timeline here. I'm hoping to only be about 20 minutes of that. So the idea is to be really engaging and ultimately adding value to you, the listener, the attendee, for joining us. And so if you have questions, like Stephanie said, please do interrupt us and stop us, and we're happy to talk those through. That worksheet that we're going to go through at the end, and that you'll receive if you stay to the end, is very similar to the concepts that we're running through here. So I won't spend a lot of time reiterating, but disability insurance has impacted my life. I grew up on a disability insurance benefit. As you heard from Crystal, a disability changed her family's life forever, and unfortunately, insurance wasn't in place. But when we're trying to talk to clients, whether we're an insurance agent, a financial advisor, or even an employee benefit specialist, it's very difficult to transition to something like disability insurance without having the right mindset and without kind of jumping into where our clients currently think about something like disability insurance. And so having specialized in this space, and disability insurance is all I do. And so I really study the behavioral aspects of this. And when advisors are talking to clients, what is that right way to talk about disability insurance? And you're probably finding out that by the heading of our presentation today, we really refer to it as income protection. And so today we're going to get into the 4 ways, or the 4-step process rather, that allows you to talk about income protection with your clients in a financial planning environment. Now, I'm going to give it away right at the beginning. So as you'll see, the 4 steps are fairly simple, but what's key here is we're not talking about product. We're not going out and getting quotes. We're not talking about riders on different insurance carrier policies. Clients do not care about that. So our 4-step process really runs through starting with thinking about the end that we're trying to take clients to, right? So begin with the end in mind. I'm a big Covey fan. Step 2 is calculating their career earnings, and we're going to use that number instead of their monthly or annual earnings. 3, you want to identify the exposures that pose a threat to them actually being able to earn that money over the rest of their career, or that income. And then 4, once you have those first 3 variables, you can very easily run an analysis of the risk and reward of purchasing an insurance policy to protect their income or some other benefit that can aid someone going through a difficult time. So step 1, how do you really begin with the end in mind when it comes to income protection? Again, going back to what is a client's mindset when someone starts talking to them about 1, insurance, but 2, protecting their income? A lot of the times clients are like, okay, disability insurance, like, how could I use it? When would I actually receive the money? And do I actually need it? And so I found that it's easiest to educate clients on when they need it, but as part of that is talk to them about when they will no longer need disability insurance or income protection. And so that's a relatively simple definition. There's really 2 options. For the sake of what we're going to run through, it's very hard to run through hypothetical situations. So I'm going to, of course, I changed the name here, but this is a recent client I helped with disability insurance. Now, 33 years old, 4 kids and a spouse at home, runs a business. That business pays him over $400,000 a year after expenses. And so you'll see that we already calculated his career earnings. We'll get to that in our 3rd step. And his business is worth about $1 million as it sits today. Why do I select a client like this to run the analysis and to show you on this webinar? It is because I talk with countless advisors who might have a client like this, who we would consider a high income client, and they'll say, yeah, but Robert, they earn so much money, they don't really have a need for disability insurance. And that could not be further from the truth, because this 4-step process that we take clients through and that we coach advisors to take their clients through, This process is what opens the eyes of individuals like John Smith and says, holy smokes, I absolutely need that in my portfolio. And so we're going to run through, using John Smith as our example, we are going to run through this 4-step process. So when would someone like John, a high income business owner, when would someone like John no longer need disability insurance? The goal here is once assets can produce income without you. And so there's really 2 options to that. 2 options if they're a business owner. One, someone like John Smith who runs a business. John, that business currently pays you $400,000 a year. How much would it pay you if you weren't present? And the way you would no longer need something like income protection is if that business can produce a sustainable $400,000 a year income without John's involvement in that business. So that's option 1. Do you have a business that can run by itself and pay you income and perhaps even grow over the years without your involvement? Option 2, someone without a business, is the only way that they can have an asset producing income is basically what we'll call a nest egg. Maybe they own real estate, maybe it's equities, maybe it's a combination of both. But what is the income being produced by those assets? And is that enough to cover our living expenses? And am I hoping to achieve a higher level of assets before I can officially say that I'm well off enough to retire, right? So again, we're in step 1 here. It's when do we need disability insurance and when don't we need disability insurance? And we don't need disability insurance when either 1, our business runs and produces an income for us without our involvement, or 2, we have a nest egg that can produce that income and we're not looking to grow that nest egg, or that nest egg is not, that nest egg does not need additional earned income. So I've said this 3 times probably already in the first slide. Our goal is to generate enough income passively, unearned income, to where the financial plan does not require additional actively earned income. I want you to write this down. When your client says, but why would I need disability insurance and when might I not need disability insurance? This is your answer. Our goal is to generate enough passive income to where the financial plan does not require additional actively earned income. Once we get to that point, that individual's actively earned income, it's irrelevant whether that comes in or not. But when we're in our younger stages and accumulation stages, I wouldn't even tie it to an age. If we're in an accumulation phase of our income earning potential and growing that financial asset, then those earned income figures or that financial plan is dependent on the ability to actively earn that income. So let's look at a thing I frequently talk about is, we have John who earns $400,000 a year. Instead of saying, John, you earn $400,000 a year, we need to protect that. We need to show John the big picture, right? If you're a financial planner and you're working with someone like John, you've put together a financial plan. That plan has forecasted savings, forecasted expenses, and forecasted retirement income goals or income targets. What you're using is not just $400,000 of John's money, it's actually the 10, 20, or 40% of that income that he'll be able to save for the rest of his career. So we really need to help John see what is that bag of money, meaning your annual income multiplied by the number of years you plan to work. So for John, who's a 33-year-old individual, again, earning $400,000 a year, if he was hoping to retire by age 67, that's $13.6 million in future career earnings. $13.6 million of future career earnings that are on the line, meaning that they are dependent on his good health and ability to run that business. So this bag of money, anytime you're sitting down with a client, and again, going back to the worksheet that you'll get at the end, it has all the equations and a very easy way for clients to actually think about this and see this for themselves as it relates to their personal scenario. But we want to show clients, we're not just going to protect your monthly income or 1 year's worth of income. We are here to protect the career earning potential. That segues us to step 3. And so once we show clients what is that career earning potential, we want to help them understand what threats stand in their way to them actually being able to earn that. Really, there's 3 things. You become disabled, you prematurely pass away, or 3, you just stop working. Maybe you hit a retirement goal early. So we're going to get into disability, of course, seeing as this is a disability insurance webinar. So by the numbers, and I share these because these are what we share with clients. By the numbers, your chances of becoming disabled for 1 year or longer are 1 in 4 or 25%. We tell clients that all the time. It's a very simple way to understand what are their odds. So if we're talking with John, your career earning potential is $13.6 million. Now, there's a 1 in 4 chance or 25% odds that you will miss 1 or more years of earning that income, specifically due to a disability. That's normally when someone like John says, okay, I don't ever really think I'll become disabled. Like, what do you mean? What really constitutes a disability? And that's when we go through the most common claims. John thinks he owns a business. He has a relatively low risk job. He signs forms, makes calls, sends emails, talks with employees, hires new people. He's not on ladders or on roofs. And we get that all fairly often. They say, nothing's going to happen to me. I'm not an over daring person, and I work a rather stable or boring job. And that's when we educate clients that 93% of long-term disability claims are actually related to illnesses, not injuries. So when clients say, yeah, but I'm not going to fall off a ladder, we say, you're right, because that's only 7% of long-term disability claims. And so on our worksheet, we're using something very similar to this graph, and it actually lists from the highest likelihood to the lowest likelihood, what are those specific disabilities that would keep me out of work for a year or longer? You'll notice that if you're looking at this graph, you'll notice that yes, musculoskeletal by itself is 23% of long-term disability claims. When you look at mental and nervous disorders and the nervous system, that's totaling 40% of long-term disability claims. So this is another thing to look into. There's some other follow-ups. If your client has employer-provided group long-term disability coverage, there are likely limitations on those 2 very specific conditions, which are, when you combine them, which are the leading cause of long-term disability claims. Now, the reason I walk you through this is because this is what clients benefit from. They don't care about catastrophic riders. They don't care about cost of living riders. They don't even care about residual or partial disability language, even though it really benefits them. We are here to educate them. And so we show them a chart similar to what you're looking at now. We ask the client, what do all of these individuals have in common? They'll usually say, well, clearly they're disabled or they've gone through a disability, and you go, correct. And then you ask, what about their occupation or their age or the reasons that they went out on disability or the amount of money they earned? What do any of those have in common? And that's when you say, the only thing they have in common is that they're all different. They're all different because disability does not play favorites. Disability is not limited to certain occupations. It's not limited to certain ages or certain incomes. Each condition is different in its own way as well. And so this is generally the eye-opening piece where clients go, wow, someone went out on disability for migraines. That's not a wheelchair. You don't need crutches for migraines, but that'll keep you from working. Now, in our final step here, step 4, we really want to look into what does this analysis look like? Okay, we've gone through when would you no longer need disability insurance. We've gone through calculating those career earnings. We've gone through what threats exist that put those career earnings on the line. And now if we were to protect your income for the rest of your career, what is the risk in doing so and what is the reward in doing so? And so one of the easiest ways to open a client's mind to, do I need another insurance premium? Do I really need something like disability insurance? We've already showed them the asset value of their income over the years. And again, this graph relates to John. I used it, not the same colors because John wasn't a huge purple person, but the data in the graph is identical. So we showed John, here's where what your cars are worth, here's what your home is worth, and here's what your income is worth. Why did we pick these 3 quote unquote assets? Is because we asked John, what do you think are your 3 greatest assets? He said his home for sure, maybe his cars because they're paid off, and then his income. Do you think that John went through that mentally, that the graph would look like this for what he had just mentioned? His income came in at $13.6 million of career earnings. His home was worth $1.5 million. And his cars, he had multiple, his cars were worth about $150,000. You think $150,000 of cars is a lot until you see it next to your career earnings on a graph. So why do we show a client this? It's because now we look at, okay, for those same 3 assets, how much in insurance do you pay to protect each one of them? Well, for your cars that you said were worth about $150,000, you're paying $500 a month in auto insurance to protect those $150,000 worth of cars. That home that's worth $1.5 million, you're paying about $400 a month between homeowners and earthquake coverage. You have to remember, I'm out in California, so earthquake coverage is a thing. And then lastly, your income. And that's where we show what John's disability insurance premium would be to protect that $13.6 million asset. Say, John, not only is income your greatest asset on the balance sheet, it's also the most inexpensive to protect. And that is generally a turning point for clients when they are looking at a $300, almost $400 insurance premium. You're thinking there's no way they can justify this. Stack it up against the other insurance premiums that they're already paying, and it starts to make a lot more sense. And then lastly here, another way to propose this or to show the analysis behind this is if we told someone like John, listen, you can have one of 2 jobs, job A or job B. Job A would pay you $29,000 a month, your current income, and it would pay you 0 if you couldn't work because of an accident or illness. Or you could have job B. Job B is going to pay you close. It's going to be about $28,615 per month. And if you can't work because of an accident or illness, it will continue to pay you $15,000 a month. And that's net of taxes, so tax-free. Which one would you choose, John? Would you work at job A or job B? I have not ever had a client that when this applied to them, they chose job B. Generally, the 1 to 2% difference in earnings is not enough to take away the loss of income if they couldn't work. And so this is probably one of the most basic ways to discuss something like disability insurance with clients. So with that, I want to make sure you know to reach out to Crystal Clark, first of all. And not to be confused, my name's Robert Clark, but Crystal and I got acquainted just by mere chance. We are not family, we're not related. And although sometimes I wish I could call her like my little sister or big sister just because she's that cool, but I don't get that honor. We want to send you this worksheet. The worksheet will take your clients through that 4-step process. It's very clean and laid out. And so since you've stayed throughout the webinar and this long, we will go ahead and email this to you because we can see how long you're on the webinar for. We will email this to anyone who is still currently on the webinar, and that's what you'll be getting today. So with that, I would love to answer any questions that came up or pass it back to you, Stephanie.
Yeah, and Robert, we do have a couple of questions. You know, I do see you as my brother from another mother. So
I love that. I made the list.
That's right. So question here from Byron. He says, are there any return of premium riders that would be worth considering?
Absolutely. So a couple carriers have return of premium options. Now, being a finance guy myself, I'm not a huge fan. It doesn't make sense to me, but I don't make the decision for clients. So yes, we have ways to propose return of premium. They are ideal for risk-averse clients who, you know, want to make protect the need, but would feel more secure if they got that money back and they no longer needed it. So like I said, 2 carriers specifically that offer return of premium. Generally, how it works is the insurance carrier would require you to keep that policy active until the client's 65th birthday, at which point they'll return either 80, 90, or sometimes even 100% of the annual premiums paid over their career.
Now, something that I've found personally with that I, like you said, find it kind of not ideal most of the time is that the premiums are substantially more expensive than some of the carriers that offer it without that. Would you agree?
Yeah, I would completely agree. And the way they show the rider on the proposal makes it look like a great deal. That's until you do your own math, because a couple of the carriers, or one of the carriers, is only refunding the additional cost of that rider. So there is still a cost of insurance involved, but the way that they show it on the proposal, it's difficult to arrive there if you're not really doing the calculation. So I would completely agree with that.
And another question here, are there any return of premium riders that you personally think, or excuse me, I apologize. Of course, I asked the same question, or I tried to. Do you think the insurance industry will ever produce a cash value DI contract?
You know, that's a great question. I would say that it's difficult when you're underwriting for morbidity and to justify that cash value, just because, again, when you look at a client's actual career earning potential or the nest egg that needs to be available, going back to this example of a 33-year-old business owner, John, the one that we're running through, when there's $13 million of career earnings on the line, how do you make sense? How does an insurance company make sense of putting that risk basis on the line and also allowing a client to benefit from the cash value? And then at what point do they? It's very similar to the return of premium, where they've tried to make it available. I will say, before I get too far onto that topic, one carrier specifically does offer return of premium on their business overhead expense coverage. Now, that is very interesting. If you aren't aware, business overhead expense coverage for business owners is tax deductible. It's a tax deductible premium. And so a business owner could fund something like that for 20 to 30 years and actually receive those premium dollars back. at their 60 or 65th birthday, whichever they contractually obligate for. So that would be the one interesting case where I feel like it might make sense. Outside of that, I do not think disability insurance carriers will create a cash value product. And I think disability insurance is very much the similar to term insurance. I think that's how you best justify it, or costs would be through the roof.
Fair enough. We've got another question here, and I think I'll maybe answer this one. It says, what is the typical waiting period? That one was from Jeff. And for me personally, I think that the typical waiting period generally is 90 days. I feel like the 90-day elimination period is sort of similar to like $1,000 car insurance deductible. It's kind of the sweet spot where you'll find, the cost to be most palatable. And what I see most people doing, they can justify or they can get away with, sort of self-insuring for those first 90 days and then having the disability policy kick in at that point. Do I see them shorter? Sure. I mean, it just kind of depends on the situation, but generally speaking, 90 days would be the spot that I see and would generally recommend. And this one, Robert, I think might be for you as well. I think we could probably kind of both weigh in, but from Chris, it says, what is the most common disability you see from your clients?
The most common disability? Sorry, I just wanted to confirm that. Like, not disability insurance policy, the most common disability claim?
Right, the most common disability claim.
I would easily say stress, anxiety, and depression.
I'm going to do a shameless plug here. So, like, we've created a series called Heart-Centered Planning, and it really goes through helping people in our industry to alleviate those types of things. And because I know for sure it's something that plagues our society, and it's an unfortunate fact. And so we definitely realize that is something that our people need to pay attention to, and employers need to implement programs and systems for their employees to help alleviate that, to keep people, healthy in their mind. Their minds are an important thing, and it's a very difficult thing to navigate if you don't have the tools. So we've created the tools. Yeah. Anyway.
I love that, Stephanie, because that is by far and large the most common threat to any professional is, and especially in the time that we're in right now with something like coronavirus. If you run a business, the thought of the unknowns will be enough stress to push out a greater percentage of people than we would like to admit. Yeah. And even outside of that, 2 years ago, I still have a friend who is currently not working simply from depression. 2 kids, loving wife, they're not divorced. He just cannot get his mind away and to clear a lot of the thoughts that he's struggling with. And that's preventing him from working in and of itself.
Wow, that's terrible. Maybe he should meditate.
Yes.
We have one more question from Adam. It says, in preparing to work on the example with John, what kind of information did you gather before this meeting? Lifetime earnings, question mark, or more data? I'm not entirely sure of this question, but I guess, Adam, for the most part, the kind of things that you would get from the client as a whole would be, what they do for a living, what their income is, like Robert had said, that $400,000 in income, being able to multiply that over, however long he's generally going to continue to work. The idea being typically 67, since that's the quote unquote current retirement age.
Yep.
Robert, do you have anything to add to that?
Yeah, so what I would add to that, and this is from experience, is that the simpler we keep it, the better. So someone like John, wildly successful business, you know, young, has kids, has a lot going on, very smart individual to operate a business at 33 years old that produces the income that it does. So there are a lot of other factors as far as, you know, what other investments are they doing? What are his reserves? Like, how does he justify his financial planning process? But I have found that digging in that deep actually takes us away from the small purpose that we need to uncover with John, and not for the sake of selling insurance, but for the sake of having the conversation. If we get too far into the weeds, we'll actually lose sight of what we're trying to accomplish. And so that's why I keep it very simple. We use the income and current age, and also with the understanding of asking the individual, is that something you plan on doing for the rest of your career? So getting their goals in mind are very important, but outside of age and income, that is all we use. You can see I don't account for that business growing in any future years, which we presume it would. I don't account for inflation either, because everyone's going to have a different interpretation of those variables. So let's just eliminate variables. Let's go off current income and their current age and when they plan to retire. With those three things, we can create this complete analysis.
Great.
Thank you.
So I've got a question, and it might be a silly question, but my area of expertise is in asset-based long-term care and annuities. And so my question is around the insurance itself. Like, he was averaging $29,000 a month. Where do you come up with the $15,000 to cover him if he has a disability?
Yeah, that's a phenomenal question. So we usually target about 60% of earnings. That $15,000 a month was a little bit lower, but how we arrived at looking at $15,000 a month is we don't try and sell as much insurance as we can. We very much have a realistic conversation of what tax-free income stream would take care of your family and still allow you to even save a few dollars every month. And so in this case, it happened to be $15,000 a month. A client earning $400,000 a year could actually qualify for $20,000 to maybe even $25,000 a month of disability insurance benefit that would also be tax-free. But in this case, the need wasn't there for the client.
Okay, great.
And on that, I just want to add that, you know, we do have additional options for people who would potentially need more coverage, whether it's with a traditional carrier or a non-traditional one. And we also have options for non-traditional professions, whether that's, you know, NFL players or, you know, somebody that maybe skydives for a living that might be pushing it. But nonetheless, you know, the point is we do have quite a few different options out there that we can tap into to make sure that, you know, your clients and clients have the kind of coverage that they need.
Awesome.
Absolutely.
So I guess one other thing I was wondering, and I don't know if you want to share a couple of carriers, but are there any concessions or anything that the carriers are doing currently because of COVID to make it easier to get this insurance placed?
Absolutely. So I would say every carrier, yes, and I'm double checking that mentally real quick. Yes, every carrier up to certain thresholds. So things like requiring a paramed exam or getting them blood and urine exams, things like that. A lot of carriers have eliminated those medical requirements for benefit amounts up to $10,000 a month. Now, there's some age limitations there as well. I believe it's up to age 50 is around where we start to see those underwriting concessions removed, but it could not be a better time to talk about disability insurance or income protection. One, you have the insurance carriers blessing and making a lot of those underwriting concessions available. So it usually right now for benefits under $10,000 a month, you submit an application, you set up a telephone interview with the insurance company and your client, and that is enough generally for the insurance companies to issue a policy. So that's a huge benefit right now. And then two, over the last 7 months, we've had a lot of people either lose their income or feel threatened by the potential loss of income. So the idea of income protection, of income security, is the top of mind with a lot of professionals right now.
Definitely. Thank you for that. All right. So I guess, is there anything else, Robert, that you would like to share with the audience before we wrap up?
Nothing that I would share that I'm afraid of starting a whole new webinar if you let me get up on my soapbox. So no, that's all from me. And again, really appreciate you having me.
Yeah, well,
Thank
you so much for joining us. And now that I know that, we'll definitely have to have you on again soon.
I would love that.
Yeah. And Crystal, do you have anything else that you would like to share with the audience?
I don't think so. Like I said, just thanks for being here. It was nice to be able to introduce myself live and in person, and thanks for having me.
Yeah, thanks for being here. Thanks for coming so far.
Yeah.
So Crystal came here just so she could be in the studio with me today. Just kidding. It's a really cool studio. Anyways, so with that, we're going to wrap up here, and you will be hearing from Crystal. She's going to reach out to each and every one of you. You don't have to wait for her to call. Her contact information is right below, so certainly feel free to reach out to her with any cases that you're working on, any additional questions that you have around what we have available. And again, thank you guys all for joining us today. I know you have a lot of options of webinars to be viewing these days, and we really appreciate you being here with us and spending time with us. I hope you found it valuable, and like I said, we'll get an email out to you with a copy so you can re-listen and get some more nuggets of wisdom from Robert. And let's see, we are going to be hosting our, the fifth webinar in our Heart-Centered Planning series on October 20th. So keep an eye out for an invitation on that. This topic is going to be around speaking your truth and the importance of that. I know it's been a struggle for me at times, so I'm really excited to bring this to you guys. And in the meantime, visit our website if you would like to get more information about our Heart-Centered Planning series. There's a tab on the top called Heart-Centered Planning. There you can check out the guides that we have available. We've got a YouTube channel that has the recordings of the first 4 webinars available. And also, please follow us on social media at The Annuity Consultants on Facebook, Instagram, LinkedIn, Twitter. And with that, you guys make it a great day, and I will see you next time. Thank you.
Thank you.
Bye, Robert.